Yeah, we're going to go through example BE2-3 from the end of Chapter 2, which references data in BE2-2. So in this problem, we're going to, again, only do the journal entries to get more practice in recording journal entries for different kinds of transactions. In this particular case, the transactions are for the Sheldon Cooper Company, which provides welding services for the month of June. The transactions are presented below. We are to identify the accounts to be debited and credited, and in fact what we're going to do is journalize each transaction. On June 1st, Sheldon Cooper invests $4,000 of cash in exchange for shares of common stock. So this is similar to what we've seen in the previous examples, an owner putting money into the company for the first time to get the company going, and in this case the owner is putting in $4,000. So the first transaction is a debit to cash and a credit to common stock.
Can I just ask you to put that perfect?
Of $4,000, the amount invested in the company. The next transaction is the Sheldon Cooper Company purchased equipment on account for $1,200. So as we saw in the previous example, this is an asset they're acquiring, and I'll indicate that with an A there. What you call it is not as important, but equipment is a standard name. This is equipment that will be used in the operation of this welding business in the future, so it has value for the company, and so that's a debit to equipment of $1,200, but they haven't paid for it yet. They actually owe the supplier, and so we're going to credit an account payable, which is a liability account, for $1,200. The next transaction is they're going to pay $800 in cash to the landlord for June rent. So this is transaction number 3. So let's think through this transaction a little bit, and this will give us an idea of how we can break a transaction into its easy parts and its more difficult parts, get the easy part first, and then work on the more difficult part and think it through. So if cash is paid or cash is received, that's always the easiest part. So in this transaction, they paid $800 of cash, so that's a credit to cash of $800. So we know that some account is being debited for $800. The question is, what kind of an account is being debited? So there are really only 2 possibilities to this. First of all, we know this is not a transaction with a shareholder, so it's got nothing to do with common stock. We know that we're not paying off a loan, so it's got nothing to do with a liability. In fact, we're spending $800 to buy something. So the question we have to ask ourselves when we spend $800 to buy something, is it something we've already used, or is it something we're going to use in the future? In this particular case, it's kind of a close call. If we're standing on June 1st and we're paying June's rent, then strictly speaking, this is something that's going to be used in the future. So this is an asset for the company, and we would call that asset prepaid rent, and we would debit an asset account for $800.
And the asset is kind of the right to
use that
office
or store or whatever it is. On the other hand, we might peek ahead a little bit and say, you know, I'm not going to prepare financial statements until the end of June. I'm not going to report to anybody what's going on in the accounting records until the end of June. Why don't I save myself some work and recognize that by the time I report this in the financial statements, I will have used up June's rent. So I might as well now, instead of recording an asset, I'll go ahead and record an expense now. Debit an expense for $800 and credit cash. If we had done the first option, then when we got to the end of the period, we would have to demonstrate or record in the accounting records that we have consumed this asset, prepaid rent. And we would do that by debiting rent expense and crediting prepaid rent for $800 And by doing these two entries together, we will have gotten to exactly that place. So there's two different paths to the same outcome. And the outcome we're getting to is recognizing in the financial statements when we prepare them that we've consumed that month's rent. And it's recorded as an expense on the income statement. So the final transaction, transaction number 4, is we send a bill to one of our customers, P. Leonard, for $300 of welding work done on account. Done on account means we've performed the work, but he hasn't paid us yet. And so in this case, again, let's think about this transaction. We've provided a service to a customer, and so we have earned revenue as a result of providing that service, and so we're going to credit revenue for $300. We're going to have a debit to some account, that is the thing our customer gave us. In this case, they did not give us cash, but they owe us the money. So we could call this money our customers owe us, but the conventional title is accounts receivable. And so we're going to debit account receivable, an asset account, for $300. So debit account receivable, credit revenue for $300. And that's our final transaction.